Um, Hello, everyone, and welcome. It's my pleasure to welcome you to today's seminar. We have a very interesting discussion ahead on the topic, is the Fed ready for the prudent risk management approach to monetary policy? As many of you know, the Fed is currently conducting a review of the monetary policy framework it adopted back in 2020. And we expect the outcome of the review to be available later in August. Over the past several months, Fed officials have increasingly emphasized the importance of a scenario-based approach, one that better manages uncertainty and addresses asymmetric risks. Interestingly, that very approach, that's also known as FPAS Mark II, was formally adopted by the Central Bank of Armenia in January of 2024. This framework emphasizes institutional credibility, transparent communication, and forward-looking risk-based guidance. Today, it's our honor to be joined by Professor Martin Weale, as well as our outstanding GFS students, who will help us explore several key questions. We will hear today from Anna Aghajanyan, Tiana Nazarian, and Susanna Grigorian, each of whom will have already prepared some insights on different aspects of the topic. And this will include whether the Fed is ready for the scenario-based approach, and also we will discuss about the effects of tariffs. We will also have more discussions on these topics in the weeks to come, and we expect a lot of exciting and interesting content to appear soon on the Better Policy Project's YouTube channel. So stay tuned. And also, finally, a quick reminder, don't forget to register for our next seminar, which is the next week on August 7 at 2 p.m. London time, where we will be joined by Charles Evans, former president of the Chicago Fed, and Armen Nubekian, who is the deputy governor of the Central Bank of Armenia. And now to start us off, Anna, please.
Thank you for the lovely introduction, Asya. I'll just share my screen real quick, just to show what I'm working on right now in preparation for the seminar next week. Okay. I hope you can see my screen. Okay, so hello everyone. I'm Anna. I joined the Global Forecasting School and the Central Bank of Armenia around 3 weeks ago. And today I welcome you to this discussion on FPAS Mark II. So as Asya mentioned, next week we'll have a very exciting seminar where we'll be joined by Charles Evans. And today we have a sort of a preamble to that seminar, and we'll go over some of the topics that will be discussed next week. And today we're joined by Martin Weale. Thank you, Professor Weale, for joining us. And I'd like to say that your feedback today will be so appreciated. So feel free to jump in at any point if you have comments during or after the presentation. And this is for everyone as well. I'd love to make this more conversational, and I'll appreciate any constructive feedback. Now, the discussion for today and for next week will be framed around the question of whether the Fed is ready for the prudent risk management approach to monetary policy, or FPAS Mark II. And this discussion begs the question of what is FPAS Mark II, and I would describe it as a specific approach to monetary policy that frames the purpose of monetary policy around the following three questions. So, one important purpose of monetary policy involves analyzing risks faced by the economy, which requires that we answer the question of where is the economy now, as well as the question of what are the underlying forces driving the economy. And secondly, we must ask ourselves how we can utilize policy instruments to achieve inflation objectives. And arguably, the most important inflation objective that we're trying to achieve with FPAS Mark II is the anchoring of long-term inflation expectations. I would argue that the most important distinction between other existing frameworks and FPAS Mark II is found in the fact that with the latter, we're able to recognize the factor of uncertainty, whereas non-FPAS frameworks tend to fall in the baseline scenario trap and the model says trap. So this approach would imply that it somehow suffices to predict the most likely scenario, which of course is an approach that does not account for the presence of risks and non-linearities. Also, in trusting the model says approach, we lose the richness of the economic narrative and we risk sliding into the so-called dark corners. Specifically, one dangerous thing that happens when risks that were not accounted for in the baseline scenario begin to materialize is that the central bank loses credibility, which complicates the process of anchoring inflation expectations. Before elaborating on what exactly FPAS Mark II is, it helps to contrast the structure of FPAS Mark II with the Fed Tealbook structure. So in the Tealbook, we have the staff constructing the baseline forecast and comparing it against the consensus forecasts. And there are many scenarios constructed, typically 6, 7, or even 8 scenarios. In fact, we have an example from the first tariff scenario from the August 2018 Tealbook, where the black line is representing the Tealbook baseline and the different, and there's also different individual scenarios involving, say, misperceived natural rates, or a positive hysteresis scenario, or an unexpected fiscal restraint scenario, etc. In contrast with FPAS Mark II, we start with the market reference scenario, and so we look at what's already priced in the financial markets, and our goal is to understand how policy can nudge the expected rate path in one direction or another. And from there, we build alternative case A and case B scenarios. So even when we think that one case projection might be more plausible than the other, say we think that the case A would be more plausible than case B, we still need to consider what the policy response would be if the risks associated with case B were to materialize. And this is what constitutes the least regrets principle, which is a very central element of FPAS Mark II. While Armenia was the first country to implement FPAS Mark II, we must give our thanks to the Fed, who inspired the theoretical and institutional background of FPAS Mark II by emphasizing the necessity of adopting risk management to monetary policy making. So back in 2004, Alan Greenspan made a key speech where he outlined a risk management approach to monetary policy. He emphasized the importance of understanding the many sources of uncertainty and trying to quantify them where possible and weighing the potential costs of different risks. Interestingly, this mindset wasn't entirely new, which we can trace it back to February 1994, when the Fed raised interest rates before there were clear signs of inflation. So that move reflected a more proactive and preemptive stance, very much in line with the risk-focused approach of FPAS Mark II. One institutional arrangement that is quite compatible with FPAS Mark II, with its emphasis on transparency, involves having board members who bear individual accountability. Actually, there's a very recent example of this from the US, with Chris Weale publishing a speech before the FOMC meetings, where he supported the reduction of the policy rate, and he also sort of provided the rationale behind his decision, which was mostly motivated by the belief that tariff-driven inflation has a transitory nature. And it doesn't matter whether we share this sentiment or not. The idea here is that this is an example of transparency, which produces an arrangement or a situation where we're able to hold individuals accountable. So in FPAS Mark II, each board member would be expected to release a summary similar to Waller's, explaining the reasoning behind their decisions and outlining any concerns about potential risks ahead. This leads us to our first and most vital recommendation to the Fed, which is that the Fed should adopt FPAS Mark II, because FPAS Mark II offers a transparent and accountable decision-making framework that is capable of implementing a risk-based or scenario-driven approach to monetary policy. As a complementary recommendation aimed at improving transparency, we suggest that the Fed should publish its FPAS Mark II projections. Importantly, we're not suggesting that the Tealbook should be published, because the Tealbook arguably lacks a clear structure for public communication, whereas FPAS Mark II offers a more structured and transparent approach to scenario analysis. Okay, this slide is not necessarily a recommendation, but it can be argued that to further ease the process of communicating the case projections, it might be useful to have a chief economist who would be responsible for presenting the staff-made scenarios on behalf of the staff, and for also for addressing analytical questions, whereas the policy-related questions can be reserved for the chairman. So having such a division of labor and the division of responsibility would likely aid communication, thereby cultivating more transparency. When thinking about the future of the economy, there are obviously many possible paths that it can take. But in practice, non-FPAS policymakers usually focus on a few key scenarios or only one scenario, typically the one that they think is most relevant or likely. Now, more advanced central banks like the Fed or smaller ones using FPAS Mark II framework, the FPAS Mark II framework, and banks that have gained experience in using the FPAS Mark II framework can go further. But and in this process, they might assess more than just two scenarios, and instead of just listing factors, they might choose to build out full and detailed stories for each scenario. However, to be transparent and to communicate these stories, the Central Bank of Armenia has introduced a taxonomy of case considerations based on the distinction between case A type and case B type considerations or projections. This is the second part of the presentation, and I will not delve too deeply into the second part because due to the time constraints, but also to maintain a bit of suspense and intrigue for the next week's seminar. But essentially, what we'll be doing is we'll be adapting the FPAS Mark II for the Fed's current context. This involves looking at how a market reference scenario is built. Then we'll present a taxonomy of scenarios based on what we believe might be published on the next Fed Toolbook. And we'll also discuss the potential impacts of tariffs, higher government deficits, and higher AI-driven productivity growth on the real and neutral interest rates. And all of these discussions will essentially cultivate in our main argument, which is that we believe that the Toolbook provides rich but often fragmented narratives, whereas FPAS Mark II can offer a more structured and consistent approach to policy analysis. And most importantly, it can help us to communicate and be transparent because it formalizes the process of scenario development, risk assessment, and forecast-based decision-making, thereby ensuring coherence between the model, the narrative, and the policy stance. So this is what I have for the presentation so far. It's still a work in progress. I will complete it by the next week's seminar, and I hope that next week it will be a productive and a very exciting seminar. So if you have any feedback, I would love to hear your opinions or anything that I should add in the presentation.
Could I say, please, that the one thing I don't think came out rather very clearly was that implicitly you're saying that the Fed has too many scenarios at the moment. I think I counted 7. And I mean, you can reasonably make the point that with 7 scenarios, people don't know what to make of them. And my understanding of the FPAS framework is that no, there shouldn't be 7 scenarios. There's the market projection and in what I've read, 2 scenarios.
Yeah, so what we're trying to say is that it's okay for them to create these scenarios, let it be 7 or 8, but these could be placed in some sort of a technical appendix, whereas we're arguing that for communicating for the public, we can make a taxonomy of scenarios. And also separately, we can put forward 1 or 2 key scenarios as well. Here is the idea about communicating. Yeah.
Okay, thank you.
Thank you.
Thank you very much, Anna, and thank you very much, Professor Weale, for your comments.